Most people think investing is just buying stocks and waiting, and for a while that belief feels harmless. But here's what nobody tells you at the start. Investing isn't one game. It's 8 different games, each with different rules, different stakes, and different players. Most people never make it past the second or third level. Not because they're not smart enough, but because they never realized there were more levels to reach. This is the full progression, from your first $500 to decisions that move entire markets. Imagine someone opening an investment account for the first time. The screen looks simple: buy, sell, numbers moving. But nothing about it actually feels simple. They deposit $500, not a large amount, but enough that it matters. At the beginning, the instinct is to watch prices. Every movement feels like a signal. But slowly, something shifts. They start asking a different question. Not what is this stock doing, but what does this company actually do? How does it make money? Why do people keep buying from it? That shift in thinking, from price watcher to business thinker, is the first real milestone. Most people never make it here. They stay glued to the chart and miss the point entirely. Returns at this stage are almost irrelevant. What's being built isn't a portfolio. It's a framework for understanding how ownership, time, and compounding actually work. Then something changes. The account doesn't just sit there, it gets fed every month, consistently. Not when the market feels good, not when prices are rising, every month. This is where structure begins. Automatic contributions flow into index funds tracking the S&P 500, ETFs focused on sectors, a few individual stocks that have been researched. A rough allocation takes shape. Maybe 60% equities, 20% ETFs, 20% cash. And for the first time, diversification stops being a buzzword and starts meaning something real, owning assets that behave differently under the same conditions. Then the market drops, not 1% or 2%, sometimes 10%, sometimes more. And this is where most people get stuck. The instinct is to sell, to protect what's there. But the consistent investor doesn't sell because they've understood something critical. Volatility is not risk. Selling at the wrong time is. Month after month, contributions continue. This is dollar cost averaging, not trying to time the market, but building exposure to it across time. The behavior is no longer random, it's structured, and the goal is no longer to win. It's simply to stay in long enough for compounding to do its work. This is where things shift. The portfolio crosses $100,000. That number changes everything, not because it's a finish line, but because the math starts speaking louder. A 1% move is now $1,000. A strong market year adds $8,000 to $12,000 without a single additional dollar contributed. For the first time, returns feel real, not theoretical. And this is where the game actually changes. Strategy becomes non-negotiable. A target allocation is set, say 70% equities, 20% fixed income, 10% cash, or alternatives, and the portfolio is rebalanced around those percentages regardless of what the market is doing. Not based on emotion, not based on headlines, based on the plan. When equities grow too large, they're trimmed. When they fall, more is added. The question evolves from how much can I make to how much risk am I actually taking to get there. Market corrections no longer feel like a crisis. They feel like part of the process. Taxes start to matter too. Holding assets long enough for long-term capital gains treatment. Using tax-advantaged accounts wherever possible. These aren't exciting decisions. But at this level, boring decisions compound into significant outcomes. Success here isn't about picking the right stock anymore. It's about executing the same disciplined approach over and over, regardless of noise. Most people struggle to reach this level. Those who do are no longer just investors. They're building something durable. Then the portfolio crosses $250,000, heading toward $1 million, and the focus shifts from building wealth to optimizing how it grows. At this point, mistakes start to matter. A 2% improvement in returns isn't minor. It can mean an additional $5,000 to $20,000 per year. Every inefficiency has a real cost. Tax strategy becomes more deliberate. High turnover investments move into tax-advantaged accounts. Long-term holdings stay in taxable accounts to minimize capital gains. Tax loss harvesting becomes a tool, not a concept. The question being asked changes shape. It's no longer just what return can I get? It's what's the probability of a serious loss, and how large could it be? Diversification becomes more intentional. Assets are evaluated not just on how they perform in good markets, but on how they behave under stress. At this level, investing becomes less about individual decisions and more about building a system, one that holds up across different environments, not just favorable ones. Because as capital grows, avoiding major losses starts to matter just as much as generating returns. Then something changes in a way that isn't just financial, it's structural. Investable assets cross $1 million, and the financial system begins to treat you differently. Public markets no longer define the entire playing field. Private equity funds, venture capital deals, real estate syndications, these opportunities don't appear on any exchange. They come through networks, advisors, institutions. The structure is different. Longer holding periods, larger minimums, capital committed for 5 to 10 years with returns distributed over time. The potential can be higher, so is the risk. Deals are evaluated on structure, sponsor quality, and expected internal rate of return, not just a price on a screen. Professionals enter the picture: private bankers, tax specialists, advisors, not to make decisions but to structure the portfolio more efficiently. The portfolio becomes more complex. Public equities still matter, but they're no longer the only engine. Capital is now allocated across multiple strategies, each with a specific role: growth, income, preservation. This is where the challenge shifts from access to selection, because at this level, opportunities aren't found, they're presented. Capital crosses into $10 million to $100 million, and now, investing is no longer something done on the side. It becomes the primary function. A 5% return is no longer a percentage. It's $500,000 to $5 million in real gains or losses. Every decision carries weight in absolute terms. The portfolio is structured across multiple asset classes, each serving a defined purpose. Public equities for growth, private equity for long-term upside, real estate for income and appreciation, fixed income for stability. A family office or formal investment entity may come into play, not for status, but for efficiency. Tax management, reporting, capital allocation, all of it runs more cleanly through structure. Performance becomes measurable against benchmarks. Internal rates of return are tracked across private investments. The question being asked constantly is this capital being deployed effectively? At this level, consistency matters far more than individual wins. Large drawdowns are difficult to recover from at scale. Avoiding them becomes a priority, not an afterthought. The identity has shifted completely. This is no longer an individual investor managing a portfolio. This is someone who operates like a portfolio manager, because that's exactly what they've become. Beyond that, the scale stops being personal. Capital moves into the hundreds of millions, sometimes billions, through funds, family offices, institutional structures. This is where the nature of investing changes entirely. The focus is no longer on individual securities, it's on allocation decisions. How much capital flows into equities? How much into private markets? How much into credit, real estate, alternative strategies? Investments happen through managers as much as directly. Hedge funds, private equity firms, venture capital funds. Each is evaluated on track record, fee structure, strategy, and alignment of incentives. A single allocation can involve tens or hundreds of millions. Due diligence is not optional. Liquidity becomes a strategic consideration. Capital cannot be moved quickly without affecting pricing. Decisions are planned over quarters, sometimes years, and when capital of this size commits, others often follow. Information flows through relationships. The network operates at a level most people never see. Investing at this level is no longer about selecting assets. It's about directing capital. And capital of this size doesn't just participate in markets, it begins to shape them. Then there's the final level. Net worth crosses $1 billion, and the entire framework changes again. Positions, not portfolios. A typical investment is no longer a few million. It's hundreds of millions, sometimes more, deployed into a single idea or company. Ownership, not just shares. Control, not just exposure. Major transactions, large equity stakes, strategic investments that influence how a company actually operates. Public markets are still relevant, but they're not the primary arena anymore. Private deals dominate, negotiated, structured, executed quietly. When a position is taken, the market reacts. When it's exited, it's noticed. Liquidity is no longer simple. Entering or exiting requires planning, timing, and deliberate coordination. Moving quickly would move the price itself. The network expands beyond what most people can imagine. Interactions happen with other large investors, institutional leaders, executives running the world's most significant companies. Opportunities at this level are rarely public. They are structured in rooms most people don't have access to. At this scale, investing is no longer about returns alone. It's about influence, where capital flows, which companies grow, which industries expand, which ideas get funded. Because at this level, the investor is no longer reacting to the market is reacting to them. Here's what this is really about though. It's not about reaching level 8. Most people won't, and that's not the point. The point is to not get stuck at the same level forever, because most people do. They open an account, make a few moves, get shaken by a correction, and quietly give up on the system before the system ever has a chance to work for them. Every level in this progression asks you to change something. Not just your strategy, but how you think. About risk, about time, about what money is actually doing when it sits still and when it moves. The gap between level 1 and level 3 isn't money, it's behavior. And that part is available to almost anyone willing to stay in long enough.